What is going on, everybody, and welcome to another weekly update. And what I like to do in these videos is provide you guys some upcoming earnings, some upcoming events to get you prepared for the week ahead. If that sounds like something you're interested in, consider subscribing. As we like to do, throw some parties around here and understand the markets and the dynamic in which it changes daily in this current environment. Now, something that I've talked about before is as of right now a lot of different events. We are more event driven heavy right now because of the fact of interest rates and what we had with inflation. A lot of the different things has been very data dependent, where before we were kind of looking at data, but ultimately understand that the biggest moves that really came out of the market were anything that essentially came out of earnings cycles, and then ultimately understand from there. We've kind of ballooned into what we're currently at with a big event that occurred with the pandemic, and then ultimately having essentially um, the war, and then the banking crisis and inflation and everything that's gone on over the past couple of years. It has really made data extremely sensitive in this given market. So that's essentially why I do this channel, to kind of get everything up to par. I do look at the macro, as I think you need to have some sort of idea where we're going, but ultimately understand that it's dynamic and it changes a lot given on what currently comes out, or what the current sentiment is on specific events, whether that's a scheduled event or an unscheduled event. The market can change very quickly, but also understand as well that charts are important as well to understand where you're going. You need to have a target and where the market could be going, and essentially try to gauge potential possibilities of outcomes. And so to be able to do that, we go off of probability. And so having a good idea where the chart is and where it could be potentially going, given off of scheduled events or, like I said, an unscheduled event. So that's why I do the channel. But nonetheless, I think again, I try to keep a lot of my stuff very simple, because this can get very complex very quickly, and it doesn't need to be that complex or that quickly. You have to understand that the market is looking for specific things, and if you can catch on to what the market's looking at that given time, you can catch a lot of good moves off the market, getting great positions for investments and stuff like that. So it's very good to be mindful of the dynamic of the market and how it changes and where the market is looking at next. Obviously, like I said, right now it's interest rates. That is the biggest thing. That is what we are focusing on. We want to see where the Fed are with interest rates and where we could potentially going. Now, given this week is going to be a very, very big week, the next couple of weeks will be big, as there are some really big events coming up. But before we get into that, let's kind of look over this past week. Now, this past week, we already know we've got a downgrade from the U.S. credit from a AAA to a AA. That is essentially caused us to start falling from the peak. Since then, a lot of big hits, 20-30% off a lot of big tech stocks that essentially have been holding up the market have pulled back since. But since that downgrade in credit, we have to understand there was a warning months ahead of time before they actually downgraded. I think there was about a 2-month warning before they started actually uh, came out with a downgrade for the U.S. credit. Now, this past week, we started off with Big 10 banks getting a warning that they could be potentially downgraded as well. The handling of what they are doing in creating more leverage tools on top of what they're already doing to create more debt is a huge concern. And so now there's another warning that these top 10 banks, including JP Morgan, including Bank of America and Wells Fargo, which Bank of America has been doing some really shady stuff as well lately, because they're essentially creating accounts of non-existent users like Wells Fargo did a while back. So understand that these could potentially get downgraded, and I wouldn't be surprised if it was this week, because given the events of this week, it would make sense that that downgrade could happen this potential upcoming week. Evergrande, you've heard about Evergrande. If you haven't, it was a big hot story last year. One of the largest mortgage companies, or companies that hold mortgages, essentially that they essentially declared bankruptcy this week. They were having a lot of issues last year. And then actually on Sunday, we did have another big mortgage lending bank as well miss a billion, I think it was $100 billion payment. This is just how Evergrande got started, but it was last year, and something I talked about. They're trying to stagger this stuff and try to draw it out, and you know, come up with other events, or try to shift the narrative away from what's actually going on. And you've seen that with Evergrande, right? Evergrande had a lot of problems in it kind of shifted away. They were not able to buy enough time, but ultimately understand that they're saying that they went under because of the U.S. and that the way the banks are handling and the problems in the U.S. banking system is essentially crumbled Evergrande, and understand that they hold a huge part of the debt, not just in China but around the world, and that's why Evergrande is such a big deal that they filed bankruptcy. And so that started driving more fear back into the market. And something I've talked about is you need new fear to drive the market back down. The market was becoming numb to all the other news that was coming out. It wasn't big enough, but now we're starting to get more big enough news, with interest rates being so high that it's starting to break stuff, and people in a lot of these companies and banks, that they can't keep up. And so what they're doing is, when their loans come to maturity, if they don't have free cash at hand, they are having to take out more business loans, and understand those business loans are very expensive. And a lot of these companies, well over 50% of these companies, can't afford the new rates. And so, being said, you're going to start seeing a lot more layoffs. And then again, a huge part of to why Evergrande had to file for bankruptcy this week, and we saw that just a couple of weeks ago with Yellow Freight. And they had their bailouts, and then they had $1 billion that had this huge interest rate on it, and they couldn't afford it, and so they had to claim bankruptcy too. This is not the end of it. This will continue to happen as long as interest rates stay high. And understand, having a lot of personal conversations with a lot of different people across the nation, across the world, things are getting really bad. People are barely making it by, and understand that uh, people are still looking for some sort of entertainment. So what they're doing is taking out loans, whether that's a HELOC loan on this huge equity that's been built up in their property, or if it's not that, they are essentially putting on their personal credit cards. We've seen debt just continue to accumulate like crazy over the past 6 months, and it's getting worse. And the sad thing is, again, something I mentioned last week, is that um, we still have a couple trillion dollars. People still have a couple $1 trillion worth of debt that they can still rack up and keep them afloat over the next couple months. But we do have student loans coming on deck in about a month and a half, and then that is what is the big concern. Now they're saying that you don't have to pay right away, but the interest will start building on those loans again in another month and a half, and that's going to be the problem. It's just putting more people in debt, because people are like, well, I just can't afford it, so I'm not going to pay it. Oh, well, that's great, and I think, yeah, there's like a year extension on it, but you're going to have to pay interest on that year, even though you haven't paid anything on that. So just imagine, with interest rates where they're at, how much more interest you're going to get accumulated. People haven't been paying that bill for like 3 years. And so now it's starting to come up, and people they've developed new routines, new spending habits, because, they have this free money. And then, the administration promised that it was going to go away, and it didn't. Right. And so, because you can't just get rid of student debt, right? It's not fair to everybody. You want to be fair. All the people that have paid off these loans, and now what do they get for actually taking responsibility of having those loans, and signing for those loans, and being aware of what they are doing with that loan to get the education that they got. Now that's a whole other debate, because I mean, you could talk about education, and it's way overpriced to some extent, especially with a lot of online training. You get a lot better online training for a fraction of the price than some of these courses that you would have to take at these top line universities. But again, you start paying into top line universities, it's not about so much the education as the networking that you get. So that's how they try to essentially evaluate the price tag for a lot of these universities. So anyway, being said, we had the FOMC meeting notes this week. What came from that is essentially that everything is still where it's at. They're still trying to keep their options open. They are very hawkish, and the scary thing is that they are talking about increasing it more. So it sounds like every time we have any kind of meeting notes or anything like that, or we have any monetary policy come up, what happens is they are kind of trying to squeeze in another interest rate. It's all based off of data. It's all based off of data, and then they're squeezing in more interest rates, right? Like we were supposed to be done at 5, and now we're here at 5.25 to 550, right? So it keeps increasing, and the problem is they're going to keep doing it. They're going to keep over tightening, and then by the time they stop, it's going to be so bad at that point. And we're seeing, again, it's going to take a while for this to fully play out. It may take another year for the whole thing to fully play out, but understand that it's going to get really, really bad when these loans start coming to maturity. That you're going to get more and more bankruptcies from a lot of corporations, and you're going to see more and more people getting laid off, and it's gonna come in big waves. And so we're starting to see what that looks like. And so again, from the meeting notes, what we got is that they're very hawkish, continuing to go forward, which that really hasn't changed, right? We got this brief hope in the beginning of the year that kind of pumped up the market, that we were going to pause, that everything was okay, AI was going to say everything. And then now we're correcting, no, that's not really the case. We're going to probably still have to increase rates. And so again, something I try to make people aware of, and why I do this channel, is because that's the underlining tone is it's not done yet. And until they actually pause, we still haven't got out of the phase 1. I talked about phase 1 and phase 2 and phase 3 of how interest rates are essentially done, right? And understand that the interest rates will stop raising. They will pause for a period of time. That's your phase 2. And then they actually start cutting rates, which is your phase 3. And right now we still haven't got out of phase 1. And then when they pause, they're going to hold it for a prolonged period of time. They almost paused a couple different times, but again, what they're finding out is that it's not enough. The demand is still not going away, because housing is also uptick back to all-time highs, which is crazy. But considering that the supply is so low, people can essentially charge whatever they want, and they're almost getting whatever they want because everything's going for a bidding war because people are afraid of a 10%. It doesn't help that you have realtors and you have the loan departments and everybody else saying, if you don't buy it now, we're going to get 10% interest rates. Now's your chance before they go up to 10%. So they're driving fear, and you can pull out HELOCs and you can do all these other things. So they're making you take more debt because essentially they're hurting for any cash flow themselves. So they're forcing the customer to have to put that risk on the table to go for something that they don't need right now, and understand that now is not the time to be buying stuff, as eventually, and then they try to say, well, once interest rates come back down, then there's going to be a flood of people. No, there's not, because people just don't have money. People can't even stay afloat. They aren't able to take a breath. And so when that interest rates do come down, like I said, when they start cutting rates, it's going to be when it's so bad that there will be nobody left there to pick anything up. So again, something I've always stated, you have to be able to survive now to be able to take advantage of when that happens, because it isn't going to be soon. We're still going to have a couple more months of this, I believe. And even if we pause, it will still be held for a long period of time until more and more and more bankruptcies start happening. So with that being said, that was a long rant there, but ultimately right now, this week we have the Jackson Hole Summit starts on Thursday. Powell's open day speech. Again, if he's not really fielding questions, that's not going to matter, but you're going to get a lot of reports out of Jackson Hole, and it's all going to be based around interest rates. It's all going to be based around the future. And so as we get down to the numbers, when we start looking at SPX, that they've priced that in. They're starting to price some of it in. So that fear in the SPX has popped back up because we have a big event in Jackson Hole this week. And so we're going to get a lot of information coming out of Jackson Hole on the plans. And last time we've had Jackson Hole, the market pretty much dumped at that point. So you need to be very, very careful what's going on. I wouldn't be surprised if we try to pump somewhat back up. I can show you in the charts that we have a little room to pump back up to do some retesting before we kind of really drop, because by the end of the week, it could get really nasty. And I wouldn't be surprised this week if we get more bank failures, as a lot of these banks, again, are in a lot of trouble, but you're not seeing that. So we had 2 more bank failures, and it was like nothing happened. The amount, even before we lost those 2 banks, was well over what happened back in 2008. and understand that currently right now it's continuing to pile up. And when you print 40% of the money supply, it's going to be a lot more. All the numbers are going to be more inflated and more crazier. And the volatility is going to be a lot crazier because you got more money in the essentially in the bucket right now. And so with everything going on, again, this week with Jackson Hole is really going to put a lot of things in perspective. And then we have the G20 summit in September, followed by monetary policy. And then we have another core in between that and monetary policy. G20 summit, again, is more aimed towards world regulation on crypto. So you got to be very careful about that, because if they start talking, there's some countries that want to straight ban it. And so if that becomes the overlying sediment, you could see a big crash around there, or a big pullback. I'm going to say crash, but I'm going to say you could see a huge pullback on crypto because of that. And another takeaway from this week that we could add is that Elon Musk, SpaceX, essentially sold all their Bitcoin. And Elon Musk is something I've talked about on this channel. He's always been in front of everything because he runs multiple companies. He has more insight into anybody that's out there on what's currently going on front lines. And he's been correct about essentially everything he said. We said we'd hit peak inflation back, it was around September of last year. And that's pretty much where we've hit it. And it hasn't really gone back up since then. That's pretty much been the peak as of right now. And then he's also reported other different aspects. He sold Bitcoin right before it dumped. He did a stock split on Tesla before all this stuff started happening. All this stuff, they did all the stock splits around this time last year, before stuff really started getting hit even more. So, and the stock split helps with these movements. So when the market gets hit because of the bear market, it's not so dramatic, because you got more shares to expense at that point, so that the move isn't as dramatic in the market, or else it could be extremely bad. And something else, again, something I've talked about and something I've seen over this past week, even more so now because of NVIDIA coming into this week, because NVIDIA is going to be a big week because of NVIDIA. NVIDIA has essentially pumped this whole market up over the past 7 months. And ultimately understand that what they're doing now, I talked about how essentially 80% of all companies have beat expectations, which is absolutely absurd number just in general. Now what they're doing, the tactic they are using, is upgrading businesses before they actually come with earnings. And so we've seen that when NVIDIA got upgraded like four or five times this week. They don't even report earnings until next Wednesday. Like, a lot of these companies don't get upgraded or downgraded till after the numbers. Why would you upgrade or downgrade a company if you don't know what the numbers are supposed to be? And that's what we're seeing. And it's not just NVIDIA. I've seen it with a couple other companies. They started about like a week or two ago. They started upgrading Apple well before their earnings, and Amazon before their earnings. And then it happened, and then they do more upgrades and downgrades at the point. But it's like now they're trying to use a tactic to keep continuing to push the market up because they are expecting that maybe it's not going to be as good. I don't know. But the thing is if NVIDIA misses by any sense and does not give these utopic numbers, the whole tech market could take an absolute dump this week. And so Wednesday is going to be extremely important after hours on what NVIDIA is actually doing. And so we want to watch and see what happens with NVIDIA. We got Toll Brothers on Tuesday. Again, that will kind of give us more insight into the housing industry as well and what's going on there, as far as building is slowing down. But ultimately understand that, again, people don't want to take out these loans. There's too much risk at hand with these high interest rate loans now for people to do that, as there's no margin in it. So why are people doing it? So again, you're seeing a huge downtick in a lot of these different things. But again, Wednesday will be very huge when it comes to that. Now, watch list here. This is what I talked about. SPX last week was sitting around 55. Now it's up to 80. So they are expecting a big move. And like I've talked about before, if the move is in the individual stock, that's more than likely because either one, there's a big scheduled event coming up, or two, we are in earnings cycle. So you'll get bigger pumps in the actual individual stocks. And then on the general index, when you see bigger pumps, it's because it's for big scheduled events. And we do have Jackson Hole is a big event. It's not super big, but if we start getting some major sell pressure, which we finally actually hit the fear indicator briefly on Friday, before it kind of pulled back, before shorts kind of covered on Friday, and then kind of pulled it back to neutral. We've been essentially in extreme greed for months at this point. So to actually see it hit neutral and then actually start going down to that fear again is something good to see, because we needed a normal pullback. The question is if we start getting an onslaught of information, of really bad information, do the Fed just automatically start cutting? I don't think they're just going to randomly just start cutting. I think they're going to stop and still have some sort of phase two where they hold it. It really depends on how the market can take things at that point, but ultimately understand when they start cutting, depending on when that cycle happens between now and this down sell, will really kind of tell us and gauge us how we could recover off of this. And so, like I said, if it all happens at once, we could price in a recession now. If it doesn't, I could see it being prolonged until next year after the election. I feel like this is kind of the dip to be buying. Again, not financial advice, but this is what I believe is the dip to be buying, because I think if we do recover, if a recession is not priced in now, between now and December, I think that's just going to be prolonged, and we're going to push this thing out all the way until election time. And then at that point, you'll actually get your recession, and ultimately understand that they're gauging a recession until 2024, which means I think we will actually be coming out of a recession at that point. I think we're in a global depression right now. And something like I've talked about before as well is that, they're not going to tell you you're in a recession till after it's happened. So if they are saying that a recession is going to start in 2024, I believe it will start recovering from a global depression at that point. So that's how you have to take that news, and take that with a grain of salt. When they're telling you it's that, I don't believe it's that. I believe that it is actually when we're recovering. So this dip, I think, will be the dip to potentially do that. But again, it all depends on the Fed rates between now and October. Maybe this is when things get really bad to where the Fed actually start cutting rates. So this is why it's very important to be watching what the Fed's actions are doing, and why they're essentially under a microscope, because people want to know, when do they pause? When do they get to phase two? How long is phase two going to be? We don't know. It could be a month. It could be a year before they start actually cutting. It really just depends on if the demand is down enough to where they want it. And if they start cutting, then we price in a recession. If that's why the timing of these things really matters, because if we could get that all timed correctly and get this whole thing essentially sold off and priced in a recession, then at that point, we could have a nice recovery going into the election, which would be what any president will want going into an election. And then we would, once we come out of or going to the election, it would be like, oh, we were in a depression, we came out of it, and we won, right? That's a great speech to give when you are the president, right? Like, will reelect me because of the fact that I got us out of a global depression, right? What better way to confront or go into an election like that, right? So these are things you have to be very mindful in what's currently going on. This is why I believe this is the dip to be buying, because of that fact. And I don't know how low we can go. We could go a lot. If you're talking about recession, remember I talked about, if an average recession is about 42% from the peak, and we haven't hit the peak. We attempted to go for back to all-time highs, but it did not happen. This is the same kind of move that's always happened. Every kind of big decline, big sell-off, is you get this rush back up to, you think you're going to hit peak, and then we stall, and then that's when the crash happens. So this could be potentially, but again, highly dependent on how the next couple series of events occur, and then we can go from there. If we get a bunch of bank failures and a bunch of stuff happening at one time, a lot of fear in the markets could sell us off enough that we would price in a recession. That would be the bottom to buy, because this could be a huge boom cycle going into election year, with the Bitcoin halving coming up as well. So again, big rant, and we're finally through that. Now we can look at some charts. Let me actually take the studies off of this here. That way it's a lot easier to read this a little bit better. So as of right now, we've had since the peak, this is what I talked about. Since the peak, essentially, when we got downgraded, we've been essentially selling off. Our 200 moving average is down here, seeing roughly around the 4,200. I think at least we would hit that 4,200, whether that's this week or by the G20 summit. I think by the end this week into next week. I think we will be seeing ourselves around 4,200. At least that would be at least be a normal pullback. Even if you were a bull, you would want it to at least pull it back to 4,200, and then potentially start pulling up from there. So keep that in mind. But again, if a bunch of series of events start occurring, this thing could start flash flooding down even further. Will we make a new low? It's hard to tell. It again, series of events need to really tell us. Our low here again was just under the 3,500. And again, I always talk about this move. It was a day move right after Powell. The market freaked out within an hour. It dipped just below 3,500 in a huge candle. This all took place within like an hour. And then by the end of the day, we had this huge candle up, and then the market's just been pushing up ever since. So again, on the way down, I think this is where you need to be paying attention to like a handful of the stocks, crypto, whatever it is that you want. You need to be strictly focused on those and be DCAing whatever the case is on the way down, because again, I think this is going to be, you're going to have a huge boom cycle out of this where they start quantitative easing after this. It could be a possibility. It could just be really nasty and sideways like we did for a long time. Remember, we chopped a long time, pretty much last year. We had some big dives, but then we would push up and chop and then dive again. That's that part of it's not over. But like I said, once we price in a recession, I think we'll make a recovery. I don't think it's going to be a huge rip up. Again, you have to understand, you've printed 40% of the money supply, and something I've talked about, the moves are going to be a lot bigger. So the move down is going to be bigger. The move up is going to be a lot bigger. But that boom cycle is what I want to catch on this, again, this last leg down, I believe. So we'll see if we can get the timing on this thing correct. Bitcoin finally started breaking down. Again, the huge sell-off essentially because of Elon Musk selling $300 million worth of Bitcoin. And so it had a huge drop down. Again, I still think this thing is going to at least tag back down to the 16, if not lower than that. Again, it all depends on timing, but I think we could at least see a revisit of the 16K mark coming up very shortly. So that's what I'm really kind of watching there. Again, Elon Musk is the leader of kind of what's going on. So after his moves, you got about 3 to 4 months before that next cycle kicks back up. So I think we got another 2 to 3 months in which we'll do some selling, and then that will lead us into going into the last, the final quarter of the year, which I think will start upticking at that point. And then I think we'll start to get, we'll get our normal cycles, I think, next year. And then right before election, around that Q2, Q3, we're going to get a boom cycle, and I think the market will start ripping back up at that point. Yeah, I think we could potentially have more of a normalization at that point. Market again separating from the economy. The economy is still going to have some problems moving forward at that point, because you still have to understand that at that point, everybody, when the Feds start cutting, everybody's going to be hurting really bad at that point. There's not going to be a lot of demand there, and that's the problem. When you are doing rates, this is something you need to understand about these cycles. When you're doing rates like this, what happens is you're killing demand. So in the worry about killing demand is you kill it so much, at what point you got that secondary phase, kind of just like the interest rates, right? Like you have that first phase which kills demand, and then you have that second phase where you're kind of, well, how long will it take for demand to come back, right? Like you got to kind of overextend to kill demand, and then you got a waiting period to see how quick people can recover to start buying again, to bring back that demand, whether that means you start quantitative easing again, throwing more money back in this to stimulate the economy, and then you get another big boom cycle into that third phase of it. So again, I think that third phase of it will start happening around election time. The question is how long will the phase 2 part of it start? Again, we haven't gotten past phase 1 yet. This is why interest rates are still increasing. So what we're watching as of right now. Now, when it comes to Tesla, Tesla just broke below the 200 daily EMA, and we did get kind of a retest on Friday. I think this thing is still settling back down. I think Tesla will more than likely be around the 150 mark. Will it go lower than that? Will it make a new low? It really depends. If for some reason inflation comes back, I think it will get hit a lot worse, and we could see under 100. But again, it depends on timing. There could be a lot of different things that happen there. But as of right now, they're still continuing to cut car prices, which is concerning to some extent in the short term, I think. But ultimately, I think it's a good thing. They're trying to take a float. They got AI and everything else. They're breaking away from just cars, and I don't think people understand that. Yes, it started out as a car company, but they own energy. They got AI. AI is going to be a big hit. It'll probably take a major hit, and that's what I'm saying. Even with Nvidia has bad earnings, this thing could be down on 150 or 150 heading towards 100 if it is bad. But I think again, one of the stocks I want to be watching moving forward. So as long as Tesla doesn't break back over the 222, I think this is at least headed down to the 150, and then we can kind of go from that point. Let's take a look at Apple is actually finally retracing as well. It kind of bounced off the 200 here, but if it breaks below the 168, then you're looking for a deeper decline to 153. The other level essentially at 135 or what I'm watching, and then obviously the bottom here at the 125 is something else I'm watching there. Palantir is also a big one I'm watching. It needs to break the $12 mark here. If it breaks below that, I really want to start accumulating under the 12 mark. From this point, you got support roughly around 10 here, and then you got the bottom obviously roughly around that $7 mark or so before this huge explosion. Again, I'm really profitable. I like the current state of the market because the next thing could be we move into a war with China, just to try to help alleviate some of these things. There's a lot of different things that can help with that, and enforcement of CBDCs. There's a lot of different things that can occur, but I think right after we get the worst of this, because China's already really fallen apart, that we will get a boom cycle, and that will help fuel the boom cycle as a war, because that's how we essentially pull ourselves out of most of these world depressions is through a world war. And so just keep in mind that could be the next thing on deck in Palantir, especially since a lot of it's cybersecurity and everything, that it would be ahead of that with AI and having cybersecurity and looking forward to that. So I'm definitely watching that one there. And then BA finally pulling back. Their 200 is way down here at 206. It could hit and be supported here at the 215. The market goes down though, this thing might actually start breaking down. So you really want to watch that 205. See if that 200 can hold. If not, you still got strong support here at the 190, which seemed to hold forever. We'll see if it can hold there or not, but that's what I'm kind of watching there. Then you got JPM. JPM did the same thing. You got strong support here, roughly around the 140. If JPM could break back below this, which again, given the current setup as of right now, it could lead to some major selling. And I've talked about these. I've highlighted these gaps that we haven't touched. Things get really nasty. We could start filling a lot of these different gaps in here. And that's what I've always said, that these major gaps, they'll get filled at some point. The point is when. So we'll look to see if this week in Jackson Hole can start doing that. But I think this video is long enough and I've ranted long enough. If you do enjoy this video, remember to like and subscribe. And until next time, I'll see you guys later.